I'm doing the most. Okay. Oh boy. Okay. I don't know why I get like giddy before it's time to read. But it's true. I do. I get really excited like when it's almost like a kid who's like parent is getting ready to read them like a bedtime story. You know what I mean? Like their favorite book comes out, you know, and then like, you know, like mommy whips out the blanket and the stuffed animal, and then all those feel good feelings come into play. That's what this book does for me for some reason. I really fuck with this author. All right, anyway, so let's jump right into the chapter 12, quiz questions and answers from the last chapter. Okay, all right, good. Yeah, so welcome back. Let's jump into it. All right, cool. So question number 1 was, what questions will you answer in your success journal? Good question. Number 1, the answer is why you entered each trade, what you can do to improve your trading performance in the future. Okay. Number 2, you're in a day trade. It's 11:30 a.m. You've made a $2 profit on the trade so far, and your stock is nearing resistance. What should you do? Answer, take at least partial profits. Number 3, what usually happens to market mood in the afternoon prior to the announcement of an important economic report? Answer to number 3 is the market usually adopts a quiet, lethargic mood. Number 4, true or false? If you're in a trade and the situation gets ugly, simply change the time frame you've designated for the trade and then lower your stop. Number 4, false, false, false. She literally writes it 3 times. It's definitely false. Okay, number 5, a market order placed before the opening bell will get filled at the open at the blank possible price. And number 5 is the highest. Number 6, buy the blank, sell the blank. I hope you know this one like the back of your hand. Buy the rumor, sell the news. Very important. Number 7, when a stock comes out with a good earnings announcement, how should you treat it? Number 7, so wait until it trades for 2 or 3 days so you can most accurately predict future price action. Number 8, some traders say if it's not a long, it's a short. Is that always true? No, trendless stocks in a volatile market make neither successful long nor successful short candidates. True or false? If a trade gone sour makes you angry, direct that energy towards your next trade. Again, you better fucking not. Like, just, let me just read the answer. Number 9 is false. You're not really angry at the stock, you're angry at yourself. Carried into your trading, anger always results in huge losses. If you feel angry while you're trading, take your positions flat, then go for a walk or even take the rest of the day off. You'll feel better and so will your trading account. Number 10, define an overextended stock. When a stock trades way above a major moving average, a good example is when a stock shoots several points above its 20-day moving average on a daily chart. Number 11, what's the least profitable situation in which to average down? Answer to number 11, you're trading short term, meaning it's a swing trade, a day trade, or a scalp, and your stock reverts from strong to weak. All right, and that's it for that. Okay, cool. So we're gonna get into chapter 13. Chapter 13 is about, it's titled Trading Survival Techniques. I'm very interested in this chapter as well. All right, let's jump in. So in this chapter, you'll find a stew of trading tips, techniques, and general knowledge I've gained through experience. There are things I'd tell you if you called on me. There are things I would tell you if you called me on the phone and we chatted as friends, as traders. The if-then mentality, how it boosts you to the ranks of professionals. The reading may be choppy today, all right? So just roll with it. Here we go. Remember a college math course called Logic? Logic used single sentences that we changed into a mathematical equation to gauge its validity. The first half of the sentence always began with if. The second half of the sentence started with then. Briefly, if both phrases in the sentence were true, the sentence was true. If either phrase was false or uncertain, the entire sentence was false. Naturally, when both phrases were false, the entire sentence was invalid. Logic reveals the truth and can be a terrific way to evaluate, for example, what a politician says in a speech. It follows that the further you travel in your trading career, the more you'll recognize correlations between diverse market occurrences. Every time you use those correlations to your advantage, you advance more quickly to the ranks of the victorious. Therefore, learn to think in terms of if, then. If might translate into some geopolitical event, economic report, or other news event that causes the markets to react. Or it might state that the positions of two indices used as indicators. Then represents probable reaction of the market to the if premise. Think action equals reaction, or when this happens, then that usually happens. Example, remember that as financial markets open and close around the world, those markets impact each other in a domino effect. If the Asian exchanges sell off at their opens, then that negativity can put negative pressure on European, South American, and US markets for the next trading day. At various places in this chapter, I'll stress the if-then circumstances so you'll understand why it's important to channel your thoughts along these lines. Stay aware of big picture dynamics. Even though you may be trading short-term time frames, you'll want to monitor major market trends. It is particularly significant when the market moves into the top of a cycle and reverts to a trendless interval. Cycle tops are always high-risk periods. Remember October 1987 when Black Monday wiped out many accounts within hours? If you didn't experience it, you surely heard of it. Other high-risk periods were October 1997, when the Asian contagion first infected our market, the disastrous summer and fall of 1998, ignited by a devalued Russian ruble, and the first months of 2000 when our tech markets were overblown and the dot-com bubble burst. High-risk zones, as illustrated in Figure 13-1, don't have to be accompanied by negative news. Often when the market balances precariously on the top of a cycle, bad news chooses that exact point in time to push the markets over the edge. High-risk zones always produce false buying signals and whipsaw conditions. Makes sense. Interestingly enough, low-risk periods, when the market is bottoming or basing, are not low risk on short-term basis. They emit the same signals and conditions as toppy markets do. False, whippy, and choppy. Why? Because they too occur when the market is searching for a new trend. Figure 13-1. Really all that's showing is the top is a high risk zone and the very bottom is a high risk zone as well. During both periods, you'll hear announcers on financial networks ask their guests, is this the top? Can the market go higher from here, or is this the bottom? Has enough panic selling occurred that buyers will start nibbling here? Savvy investors and traders track market trends because it enables them to position themselves advantageously. At the culmination of a major uptrend, when the market rolls over into a high-risk zone, they build cash reserves and trade in short time frames only. When the market bottoms after a downtrend and begins to move sideways in a so-called low-risk area, remember, it's low-risk long-term, not short-term. It's time to cover shorts again and build cash supplies to prepare for selective buying. See why traders often say the trend is your friend? During a definite uptrend or downtrend, we all agree on which road we're taking. When the camp divides after a protracted move, none of us agree on direction. We end up bumping into each other, and many times we both get injured. When the market turns into either one of these cycles, my advice is to observe without playing. A few intraday trades, occasional swing trades of market trending on their own make sense. During these times, many traders switch to their futures account and trade the mini stock index futures contracts. More than that is gambling. I've held position trades through reversal patterns early in my trading career. Ouch, did I lose money? I couldn't get on the right side of anything. And I wasn't the only one. Disasters littered trading rooms everywhere. So how can you track big picture dynamics? Check daily and weekly charts of the Dow, NYSE, and NASDAQ 100 or composite. Draw trend lines and plot 20, 50, and 20-day MAs on them. I like 30 and 39-week MAs on weekly charts. They correspond to 150 and 200-day MAs on daily charts. Ask the usual questions. Are the indices trending or trading horizontally? Where is support and resistance? Are they trading above or below the major moving averages? Which markets are overextended? You don't buy a stock trading under the 20-day MA and especially the 50-day MA. Smart traders tread carefully, or not at all, when the broad markets exhibit the same behavior. If many traders and most investors had followed and interpreted daily or weekly charts of major indices from January to March of 2000, they would have exited long positions and saved trillions, yes, trillions of dollars in profit. Now you're one of those in the know. You needn't ride out such a drastic move. You know when stocks or indices are overbought and preparing to roll over. You have the savvy to protect your principal and your profits. If the market is in a high risk or low risk zone, then trading conditions will be whippy, choppy, and unpredictable. Trade only short-term positions, if at all. Save cash for a stock shopping spree when the market breaks out of this zone. The advanced decline line as a superb storyteller. One of the most popular long-term indicators of market breadth, and thus overall market strength, is the NYSE Advanced Decline Line, or AD line. Here we go. Why can't I say that word? Indicator uses advancing and declining issues to measure participation in the movement of the market. When we're in the, and by the way, the word BREADTH, we're gonna leave it at that. Okay, I don't know why I cannot pronounce it. When we're in the midst of a strong bull market, did I even finish that sentence? What the fuck? But when we're in the midst of a strong bull market, a large number of stocks climb upward in orderly patterns. If that market starts to deteriorate, only a small number of stocks make large advances in price. To the uninformed, it appears the bull still feels frisky because those stocks pull the averages up. The appearance is not the reality, though, and the AD line tells it as it is. Conversely, as the market bottoms after a downtrend, fewer and fewer stocks decline even though the market indices still slide south. The AD line is calculated by subtracting the number of New York Stock Exchange stocks that decline on the day from the number of issues that advance. This is added to a cumulative total, though the actual numbers that designate the line mean little. The pattern it draws tells a very vital story. If it isn't available on your trading software, you'll find the AD line published in Investors Business Daily, the Wall Street Journal, and other financial newspapers. Compare it to the Dow or the S&P 500 index. Now look for the divergence. Reassuring signs of a strong market combine in a rising AD line with new highs on the preceding indices. But when you see the Dow, for instance, making new highs in an uptrend, and the AD line is forming negative divergence by rolling sideways and falling and failing to make new highs, it's time to pull anchor on the long-term holds. If the Dow and the S&P 500 continue to make new highs and the AD line doesn't, then the market may be headed for a spill. Go to cash, hop in and out nimbly with intraday trades and get ready to hold the door open for those who don't have your insight. If declining issues outnumber advancing issues, then the markets are weak. If advancing issues outnumber declining issues, then the market is strong. Meet another storyteller, U.S. 30-year Treasury bonds. The 30-year Treasury bond is the benchmark for all bond prices. Along with the stock index futures, the T-bond futures indicates how the market will open. Since these bonds trade 24 hours electronically, the bond futures react to international news, to foreign markets that trade while we sleep, and to the U.S. issues active in those markets. Bond futures also watch and react to U.S. economic reports and other important news. Bond prices and bond yields, meaning their interest rates, move in opposite directions. As bond prices rise, their interest rates drop. When low interest rates generated by bonds make them less attractive to investors, Those investors look to stocks for more attractive profits. Result, stock prices rise. Finally, remember that interest rates equal the price of credit, which in turn reflects the growth rate of the economy. The bond traders watch economic reports with the same intensity of cats staring into gopher holes. Inflation is the bond trader's enemy. It makes sense because rising prices in goods and services cause the current value of the dollar to shrink in the future. When good employment numbers or strong economic growth numbers are announced, the bond market turns paranoid. The seemingly positive reports as a sign of rising consumer prices, a negative to bond traders. Check my website and click on the Econ Calendar View section for the following week's economic reports. As soon as CNBC or another financial network announces these reports, usually 8:30 a.m. or 10 a.m. Eastern Standard Time, the bond futures and mini stock index futures reveal how Wall Street interprets those numbers. Say an economic report such as lower unemployment numbers infer the economy is strengthening. Translate the report into an if-then equation, such as if the economy strengthens, then higher interest rates follow and bond prices fall. How will the market react? In this case, the stock market may fall because a strong economy can goad the Fed into raising rates to curb inflation. Rising rates means companies have to pay more to borrow money, which leads to lower earnings. Lower earnings equals lower stock prices. Hot tip: inflation is the rising cost of goods and services. Those reasons encourage investors to embark on a flight to safety. They cash in their stocks and put their money in high-yielding bonds. Or say the economy shows signs of mild strengthening, and the general consensus holds that the Fed will not raise interest rates. The stock market rises because stockholders see higher earnings ahead. Again, the T-bond and E-mini S&P futures will tell you immediately which opinion prevails. If-then scenarios comparing 30-year Treasury bond futures to E-mini S&P futures. All right, so number one, if bond yields fall and the E-mini S&P futures rise, then cyclical stocks that act best in strong economies as opposed to stocks with earnings handcuffed to interest rates, show strength. Cyclical equity groups include paper, aluminum, chemicals, technology, heavy construction, and retailers. Examples are International Paper, Aluminum Company of America, the Dow Chemical Company, the Hewlett-Packard Company, Caterpillar Inc., and JCPenney Inc. Number two, if bond prices weaken, yields or interest rates rises, then interest-sensitive stocks like banks, like Citicorp, money lenders, American Express, and home builders, the Lennar Corp, or LEN, may weaken with them. Higher interest rates means banks have to pay more to borrow money. Thus, their spread between what they lend and what they borrow narrows. In addition, as interest rates rise, people stall on buying new homes. Number three, if bond prices are strong and S&P futures are weak, then cyclicals usually recover strength first. And number four, if bond prices are strong and S&P futures are strong, then look for banks, lenders, and home builders to climb. Hot tip: traders also watch the 10-year Treasury note and the 2-year note and compare the yield difference. The yield for the 10-year note should be higher because investors should be compensated for holding these instruments for a longer maturity. When the yield curve becomes inverted, the two-year yield is higher than the 10-year yield interest rate. It does not necessarily forecast a recession, but historically, this has taken place more times than not. Other if-then settings. If oil prices rise, then transportation stocks fall, and vice versa because higher fuel prices shrink profits. If signs of inflation climb, then gold and silver stocks rise. Investors buy these instruments to hedge against inflation. Besides individual gold and silver stock, traders can now buy gold and silver ETFs. iShares, COMEX gold shares, Street Tracks gold shares, Market Vector gold miners, and the iShares Silver Trust. If the US dollar strengthens, then imported goods become more attractive to Americans. Stocks like Nike and the Toyota Motors Corporation rise. Conversely, American products sold overseas cost more, so stocks like Intel Inc. and Johnson & Johnson may suffer. If the CRB index, Commodity Research Bureau Price Index of 22 commodities, falls, then inflation is not such a worry. Bond and stock prices rise. All right, hot tip. Commodities are defined as either raw materials or products nearing the initial construction phase. Think crude and heating oil, industrial and precious metals, rubber, corn, cattle, hogs, sugar. We say that they are sensitive because their markets are instantly affected by changes in economic conditions. Rising commodity prices usually indicate impending inflation. If it costs more to buy the commodity to manufacture the products, those prices are eventually passed on to consumers. Okay. Yeah. All right. Too much chocolate. The next two overall market indicators represent inverse sentiment. Translated, they suggest that too much of anything, whether good or bad, eventually causes the opposite reaction. Take chocolate, for instance. Chocolate, a good thing. When eaten in huge portion, causes a stomach ache, a bad thing. Advisor Sentiment Report. Investors Intelligence in New Rochelle, New York, conducts a weekly poll of investment advisors and publishes the Advisor's Sentiment Report. CNBC routinely announces the report results, and it's closely monitored by the investment community. The poll tallies how advisors feel about the stock market, bullish, bearish, or neutral. The ratio is calculated by dividing the number of bullish advisors by the number of bullish plus bearish advisors. Neutral advisors don't count. Since it's a contrary indicator, the more bullish the advisors feel, the more bearish the indication. The opposite is also true. For example, if 55 to 60% of the advisors polled are bullish, then that extreme optimism and euphoria usually signals the market is top-heavy and ready to fall. If the reading dips to 40%, verifying extreme pessimism and bearishness, then the index implies a bullish reversal is in the wind. The CBOE, Chicago Board Options Exchange, total put call ratio. The CBOE total put call ratio tracks both equity and index option put call ratio. Puts and calls are options contracts that give participants the right to sell or buy the underlying security at a specified price during a limited time period. You can access the ratios for the total put call ratios at www.cboe.com. Click on data and then CBOE daily market statistics. Because this is a contrary sentiment indicator, you can interpret it like this. The higher the level of pessimism in the options players, the more optimistic the outlook for the market. The lower the level of pessimism, the more bearish the actual outlook. Or the higher the put, think selling, trading, the more bullish the indication. The higher the calls, think buying, trading, the more bearish the indication. The indicator works best at extremes. For example, a reading in the CBOE equity put call ratio of 0.60 is considered bullish. When the index soars above 1.0, however, that's heading into a very high level of pessimism. Extreme pessimism usually tells us that bulls will soon begin to nibble. On the flip side, bearish signals flash when the ratio reaches 0.40. When the ratio drifts below that number, market players are too optimistic. Look for an impending market reversal led to the downside by the bears. All right, cool. So we'll stop there for today. She starts kind of jumping into like options expiration week, and then goes on to talk about how to change gears in the market. So let's stop there for now, and then we will pick it back up tomorrow. Cool. Good read for today. Thank you again for joining, and I will see you very soon. Tomato.